Hey, what's going on everyone? Little Fish Investor here with another video, and today we're going to be talking about how insanely good selling covered calls can be today. Doing all the research and stuff, going into what selling a covered call is, all the benefits on it, and basically, the little bit of, the cons to it as well too, because there's always cons to stuff. But the cons are so little on there, at least potentially they can be, but there are so many positive things that can go into sell a covered call. So that is what today's topic is going to be on. So essentially, selling a covered call is going to be the opposite of the last video of selling a cash secured put. So in this situation with selling a covered call, you actually have to own 100 shares of that underlying stock. So in our example, just like the last video, we're going to use Workhorse, which actually has gone up in price since that last video. Now, essentially, let's just say that we are buying Workhorse at the share price today, right? Let's just say we bought 100 shares today at $9.13, okay? It's just a scenario. Alright, so my average cost is going to be $9.13. You have to own 100 shares because to be able to sell one contract of this option, you have to have 100 shares of that underlying stock. So, we're essentially going to have $913 up front to purchase this this option, but also to buy the stock, because we're actually going to own the stock, right? Now, we own the stock because we believe in this stock, for the long term on there. We believe, what the company is about, and that is going to do great things on there. So we actually own this stock. If they pay a dividend to you, you get to keep that dividend and all that. So how do you do this? Well, in Robinhood, essentially you're just going to go to that stock. You may already own that stock, or let's just say you want to use this on a new stock that just to play around with, but you believe in the company. So essentially you're going to go to trade options, and then you're going to be at this screen here. You're going to make sure that, you're going to buy the stock. You're going to buy 100 shares of it. Then after you own the stock, you're going to go to trade options, and then it's going to bring you to the screen here. Then you're going to hit sell and then call, and then you're going to choose the expiration date that you want to choose. Alright, I typically use a week. You can do 2 weeks, 3 weeks, month, a year. Typically some options can go out to 2 years. Some options are only monthly, some are only weekly on there, so it all depends on the stock that you're trying to do it for. But basically, you choose an expiration date that you're comfortable with. And initially, the higher volume the stock, typically the longer that you go out with, you're willing to risk, that potential of it actually, hitting that one. But if you believe that it's not going to, and you really want to keep your shares, then, just do your research about it, just seeing like if it's going to go on there. But you gotta risk it to be able to collect that higher premium. So we're gonna go back to June 4th here. So essentially what I mean by risking, so let's just say that we bought at $9.14 a share. That's our average cost, and in a week I don't think that is going to hit $10. Okay, so essentially what that means is that I have to feel comfortable with, if it hits $10 on there or higher, I have to sell 100 of my shares at $10 a share on there. Now the cool thing about it is I collect that capital gains between the $9.14 to the $10 on there. That's a small, cool, quick buck on there. And then also keep this premium. Now, just like in the last video, the premium is essentially what the buyer of this contract is going to pay you, because they are essentially gambling that it will hit $10 or a little bit higher for their break even, to essentially make the capital gains on there, because then they get, let's just say it hits above $10, let's just say it hits $10.50, that's the buyer, then they get to buy the 100 shares at $10, so they collect the difference between the $10 and the $10.50. Okay, so there's a lot more to going into when it comes to buying a cover call. A lot more things need to work out compared to selling a cover call, because the only thing that I'm missing out on is if it goes above the $10 on there, I miss out on that potential capital gains on there, which that can be endless. Let's just say it goes 10 to 20, which is a little bit unrealistic, but anything can happen. Then I miss that. So you have to feel comfortable at selling, that stock at a certain strike price on there, just in case something crazy ends up happening. You will miss. You're okay with missing out on that potential, loss on there. But for the most part, it's favorable. So then I'm going to get paid $27, because this is again times 100. So 27 cents times 100 is $27. So I'm instantly going to get paid $27 to write this call option. That $27 I can do whatever I want with on there, and then essentially we wait until a week. It goes out and just see what ends up happening. Now, if it never hits $10 at all, then I just keep my 100 shares. I also keep that 27 cents premium, because that person that ended up gambling did not actually get in the money there, so he just lost that $27, and I keep that. I keep my 100 shares. I also collect any dividends on if that company, because I own the 100 shares, decides to pay me out on. So guys, it's just almost a win-win on there. Even if it does hit that $10 on there, I felt comfortable at selling at $10. I made that potential gain on there, and then I also got that $27 as a premium credit, and then I can just go ahead and buy 100 more shares of that company again, or another company that I want to play around with and I believe in with it. So a lot of exciting things go into selling a covered call on there, and it's a lot less risky on there. So that's it for today's video, guys, and I'll see you in the next one.